Hi, everyone. Welcome to our webinar today with our guest, Tom Alexander. He is sharing his desktop. We anticipate a larger than normal turnout today. And if you log out, you may not be able to log back in. Okay, as it's time, we'll go ahead and get started. Hi, everyone. Our guest today is Tom Alexander. Tom is a trader, author, educator, and founder of Alexander Trading, and is a partner and trader for Cross Creek Capital, a hedge fund. He has been trading for 35 years, during which time he has been a stockbroker, commodities broker, owned a commodity futures brokerage firm. He was a commodity trading advisor and was involved in institutional trading and consulting. Tom has been published in several well-known trading magazines and is frequently quoted by Reuters, Dow Jones, and Bloomberg. He is the author of Practical Trading Applications of Market Profile. Tom is joining us today from Savannah, Georgia. Tom, in my opinion, is one of the top guest speakers we have had in terms of real broad screen-based trading experience. He has been a frequent DTG guest speaker in our current webinar format and our past in-person events held in hotel ballrooms. The topic today is the #1 reason traders fail and what you can do about it. Tom, thanks for joining us today and welcome back.
Ron, it's a real pleasure. Thank you so much for having me. Guys, thank you for taking a little bit of time out of your day. I know as a trader myself that it can be a long, tedious day, and maybe you don't want to sit in front of that screen for another hour after the markets are closed. So I very much appreciate you taking the time to do that, and hopefully I'm going to share some things today that will be helpful to you. Ron is an old trading friend of mine. I've been trading a long, long time, but I haven't been a trading educator but about 15 years. But when I first started as a trading educator, one of the first presentations I gave was to the Denver Trading Group. Ron invited me to Denver, and I came up and gave a presentation to the group. And as he mentioned, I have given several in the past. Ron is one of the real jewels in this business. Just so you guys know this, he is a voracious student of the markets and of all things. He's sort of a Renaissance kind of guy, and I really appreciate that about him, his intellectual curiosity and his intellectual honesty. Those things can be rather rare in trading, as I'm sure some of you are aware. And I just want you to know that his group, the Denver Trading Group, is a fantastic resource for traders. And Ron is not going to steer you off the path. He's a very straight shooter. So I'm flattered that he has invited me to come and speak to you guys today. And I hope I can do his confidence in me justice. The topic today, and I'm not going to, some of you may be a little bit disappointed with what I'm going to show you today, but I'm going to show you some things that I think are really, really critical, important in trading. I'm not going to show you a bunch of trade setups and how much money you can make in trading and all this other nonsense that you typically see. You get that, you're inundated with that. I am going to share, and this was not hyperbole, the #1 reason that traders fail. And it's surprisingly simple. We become rigidly invested in our beliefs. And this is human nature. There are several books that have been written about this very thing. The best trading books, I've been trading for 35 years, and yesterday, Ron and I just had a great conversation. I bet we talked for almost an hour just talking. And Ron and I share very, very similar backgrounds in how we approach things and what the lengths that we've gone to as traders to perfect this craft, this profession. And one of those things is that we both are big readers. But I have not bought a implicit trading book in, I don't know, 10 or 15 years. But I've read many books that are fantastic trading books. They're not about trading, but they're fantastic trading books. And one of those books that I highly recommend that you read is Daniel Kahneman's I think I'm pronouncing that correctly, Thinking Fast and Slow. It's a brilliant book, and it talks about our propensity to justify our beliefs and why we do that. And it's if you read this book, it is uncanny. You will see your reflection in there. I mean, I certainly saw mine. But when I read this book, it also gave me many, many ideas about my trading, but also about sharing those ideas with other people. And that's really the theme of today. And it's something that I think you can learn from. I think we can all learn from it. I'm very comfortable in how I trade and what I do. I have proven that it works. I have proven that I can execute my trade plan. I have a trade plan. I record my trades. You need to do the same things. But that said, I am increasingly, over the 35 years, if one of the things that trading has done for me / to me, it has humbled me. If I was not humble before, and there are those that would say that I wasn't, I am certainly humble now, because trading is, for me, the most humbling thing that I've ever attempted to do. So I can empathize with traders who go through trading, and I can recognize especially when someone that is getting into trading comes to me and wants to learn to trade. I've gotten pretty good at reading people and personalities. And Ron and I, this was part of the conversation I had with Ron yesterday. You have a high achieving group as a rule that gets into trading. You have a higher IQ group, a more accomplished group in terms of education level, in terms of professional success. It's not, you do have the idiots that come in and, blow all their money because they believe the nonsense, but there's an extraordinarily type A group of people that come into trading. And I mentioned this again, something that I talked about Ron yesterday. People think that you have to be really smart to be a trader. Well, you don't, but you do have to have some sense. As a matter of fact, sometimes this super high IQ type accomplished person, their intelligence gets in their way. And it's an emotional business, and everybody knows that. And this speaks to that, what Kahneman is saying here. Finally, the illusions of validity and skill are supported by our powerful professional culture. This is really, really spot on. We know that people can maintain an unshakable faith in any proposition, however absurd, when they are sustained by a community of like-minded believers. So this is why all of us have gone through this struggle initially with trading. I did. Ron will, I'm sure, confirm that he did. I don't know a successful trader that just hit the ground running and never looked back. I don't know of a single one. And I know a lot of traders. I have known a lot of traders. So this is the number one reason that traders fail. Now, we all want to really, really become profitable traders. We will spend, and this conversation with Ron yesterday, and he did not know what I was presenting today, but it was almost like he was dictating my presentation to me. It was quite a serendipitous conversation, sort of eerie in a way. We'll all spend tens of thousands or hundreds of thousands of dollars in some instance, both in terms of buying software and platforms, as well as losing money to become profitable traders. But at the net of it is, we seldom want it enough to admit the way we've been going about it for X number of years, whatever that number is, doesn't work, even though our results are proving it doesn't work. If you've been trading for 4 or 5 years and you aren't making money, and you've been trading using the same methodology, the same oscillators and Fibonacci numbers, and I can go on and on and on, and you can't make it work, it's not going to work for you. It's not. And maybe it's not valid, and maybe you need to take a look at something else. Maybe you need to question what you are doing. So there's just one of the hardest things we have to do is getting rid of all the software we bought, all the trading platforms, the indicators, and the methods that we spent hours and hours accumulating and slaving over. We become slaves of confirmation bias. Once we have all this stuff, any scintilla of evidence that it could still work, we latch on to. And having a profitable trade doesn't mean you have a profitable methodology or profitable trade system. You can sit in front of your screen and flip a coin going long or short, you're going to have profitable trades. But that's random. Random results result in losing all your money sooner rather than later. Now, something else that was quite serendipitous when I was working on this presentation, I ran across an article on the internet, and I invite you to Google this article. And this person, this Liz, I don't know how you pronounce her name, Bore. This woman is brilliant, and I read her article, and it was absolutely fascinating. And this is the name of the article: How an 18th Century Priest Gave Us Tools to Make Better Decisions by Liz Bore. And this is one of her quotes from that article. When we identify too strongly with a deeply held belief, idea, or outcome, a plethora of cognitive biases can rear their ugly heads. So I strongly encourage you to make note of this. Liz Bore, you can Google it, and I'm sure this article will come up. But it's an outstanding article. Now, I want to talk about some of the usual suspects in adding to this conundrum that we have as traders. We have the trading industry, we have other traders, and we have a complete misunderstanding of the trading profession. Now, the trading industry itself does not help us become traders. And the trading industry is comprised of this cast of characters, and I may have left some out, but these are the primary characters within the trading industry. We have the regulatory agencies, the exchanges, the brokers, the software developers, and the trading educators. I refer to them affectionately as magicians. Now, this is the typical mantra of the trading industry from all of those parties above. Trading is easy. We can learn how to trade in about the time it takes to learn how to make toast. There's a magic secret. All we need to do to unlock all of this crap that we've bought and we have on our screens is for someone to share the magic secret with us. And there's someone that's sending an email to us this very minute that's willing to share with us and 10,000 or so of their best friends the magic secret. The magic secret has been sold to traders as long as I've been trading, and long before. If you've ever heard of W.D. Gann, that's one of them. Any and all trading experience is the same. Well, it's not. The trading education business is full of ex-floor traders because there's no longer a floor. And so ex-floor traders who are really market makers are going to now teach people how to trade in front of a screen. It's folly. They are no more likely to be able to teach you how to trade in front of a screen than if you transported me back to 1986 and put me in the S&P pit. I couldn't do it. But I have been trading in front of a screen for 35 years. All trading experience is not the same. And this is one of my favorites. The normal rules of compounding and rates of return don't apply to trading. I will invariably be asked by someone. Someone will call me on the phone and say, all right, I want you to, I'm interested in your trading courses. I'm interested in what you're doing. I saw this and it's trading. And they say, well, I have $100,000. Can I make a living on that? And I'll go, well, what are your living expenses? Do you think you can, if you're spending $120,000 to live, or do you think you can make 120% on your money? And obviously the answer to that is no, you can't. The normal rules of compounding and rates of return don't apply to trading. When you get these emails in your email box that says, well, 30% month after month after month, take a calculator and take your account size. I don't care if it's a $5,000 account, and compound it at a 30% rate of return, monthly rate of return. And, within 5 years, you're the richest man that's ever lived. Trading doesn't work that way. That's not realistic. Now, the regulatory agencies, all they're concerned with now is primarily the bigger picture concerns, things like money laundering, outright fraud, and it's sort of a fingers in the dike. There are so many carnival barkers and charlatans and grifters out there. They're too busy to really be effective in terms of regulating this industry. This may be the last vestige of the Wild West. Now, exchanges and brokers, they certainly do not do traders any favors. It's a transaction-based business model, fees and commissions. Exchanges and brokers don't make money unless transactions occur. And this presents an inherent conflict between what's best for the exchanges and the brokers and what's best for their customer, especially the retail customer. The exchanges are primarily catering to the larger institutional investor now. That's always been the case, and it's just good business. It makes sense. But the reality is it's never been more so than it is today. You are the little guy. You and I are the little guy. I don't care how large your account is. It's not, $1 billion. You're not, they're far more concerned with Ray Dalio than they are you and me. Okay. Now, the software developers, the guys that are engineers, people like Ron, for instance, and I say that affectionately. I think Ron's an engineer. I don't know if he programs stuff, but all engineers and software developers think that they are going to be able to write the magic code that solves the problem. Charting platforms are the race to indicator infinity. My charts, and I admit, I've trained myself and I train other traders to look at a market profile chart and a bar chart, and that is all you need. And I'll talk about that a little bit more later. But charting platforms, their selling point is more colors, more indicators. Then you have the execution platforms where they're advertising that you can get faster execution. And I will just tell you this: if you think your profitability depends on another millisecond or two, or even a tick or two in a given contract, you don't have a trade plan that has a positive expectancy. Know what you are. You are an off-floor trader. You are not going to be able to compete with the high-frequency trading guys in these hedge funds and institutions that have extraordinarily lightning-fast computers pre-programmed. You can't do that. Believe me. I have known people that have made small fortunes scalping. I have never known a single one that kept it. Not one. Then, of course, you have the systems developers that are going to solve the equation. I started out with this. And this reminds me of the witches and the witch doctors of the world, where they're going to create something and spin straw into gold. Trading educators, of which I am one. That's one of the hats that I wear. And I always tell people when I give a presentation that I want you to listen very carefully to what I say and write it down. And then I don't want you to believe a word of it. I want you to disprove it. I want you to question it. And then I want you to do the same thing with everything else that you have, all the stuff that you have on your screen, all your trading books, all your indicators, everything that everybody's telling you in a chat room all day long. You don't want to believe a word of it. Prove it or disprove it. Now, again, don't believe anything I'm telling you. Disprove it. And then let me know. You will help me. If I am wrong in what I'm saying, you'll be doing me a favor if you can send me an email. I'll give you my email address at the end of this and say, Tom, you're wrong about this. Here's why. I want to know. I mean that sincerely. Other traders, this is your worst source of information, people. Other traders seek out other traders because we're sitting home alone in our boxer shorts in our home office and we get bored and we don't have anything to do. So we sign up for a chat room just so we can commiserate with other traders and see how much money all these people out there are making. And man, you get in a trading room and everybody's making money, aren't they? Well, what you have the blind leading the blind. You know, in this business, in the trading business, 90% of traders are fail. That's a pretty standard industry statistic. So if 90% of the people you're in contact with are failing, why are you paying any attention to them? Why are you believing anything they're telling you in a chat room? So all of the things that I just went through are put in a blender, and the product that comes out of the blender are our beliefs about trading. And we're very defensive about those. Very, very defensive. You know, I have clients. You know, I've been a trader for 35 years. I've been a formal trading educator for 15 years. And one of the most difficult things I have when I'm working with people is to get them. They'll come to me and they'll pay me to teach them how to trade, and then I will say, okay, well and then I basically ask them questions. Why are you using this? Well, it's because this, and this. I go, well, if it worked, you wouldn't need me. That doesn't work. Stop using it. And I always have people send me their trades. That's the process I go through with people. I'll review their trades and to see that they're using and understanding the methodology that I'm teaching them to use. And I have such a difficult time getting them to see that they're still using what they came to me, what they were using when they came to me, and they're not listening. They'll study the material and then they go back, and when they trade, it's the same thing that they were doing before. So it's human nature. And once you can get over that hump, then you can make some real progress. But we have to be willing to question what we're doing. So how do you overcome this? Well, you think critically. Again, you question everything. You know, Google critical thinking. Critical thinking is one of my favorite topics. I have 4 children. My youngest child is now 16 years old. And you know, one of the primary things that I have tried to do as a parent is to teach my children to think critically. So regardless of what you're doing, critical thinking is good, especially in trading. For some reason, traders get into trading, you know, really bright people, doctors, lawyers, engineers, highly successful business people that are, you know, practice critical thinking in their lives and got where they are through the critical thinking process. They get into trading and then they turn the critical thinking switch off for some reason. We'll turn it back on. So treat trading as a business, as a profession. It is a profession. It is a very serious profession. It is not something that can be learned overnight. It is not something that can be learned in a week. It is not something that can be learned in a month. It's not something that is mastered in a year or two. I've been trading 35 years, and every day I wake up more humble than the previous day, and I'm trying to learn something. You never know it all. Now, if you're a part-time trader, it does not negate the need for effort and rigor. You still have to approach this as a very serious endeavor. It is a very serious endeavor. Know what you're doing and why. Ask yourself what all that stuff on your screen means. Exactly what does it mean? What is it supposed to be telling you, and how is it telling you that? What are the results from using it? Accept that there is no magic. Any tool or methodology that you use has to have a logical basis. If you can't explain it to your wife or one of your friends that knows nothing about trading in about 5 minutes and it makes some logical sense to them, it's probably not valid. Have a trade plan. I'll bet you 90% of the traders that think about this. If 90% of the traders fail, I bet you 99% of those traders that fail don't have a trade plan. Well, I know what I'm doing. You know, I know what I'm doing, so I don't need to write it down. Well, you do need to write it down. And this is something else. Keep records. Specifically, keep a spreadsheet of your results. The more detailed the spreadsheet, the better. Time of entry, number of contracts, number of contracts, time of entry, time of exit, why you entered the trade, the net result, where you got out. And then take your chart and put bought here, sold here, and then make some notes. Don't think for a second you'll remember that at the end of the week. If you go back on Friday and try to remember the trades you took on Monday, you're kidding yourself. I moved from Atlanta to Savannah about 10 years ago, and I had a large master bedroom in the basement of my home in Atlanta that I used as a home office. I had an off-site office, but then I had an office at home. And in that bedroom, that master bedroom, had two very large closets in it. It was full of bookcases, and those bookcases were full of books, and they were full of charts. I had I don't know, thousands and thousands and thousands of charts that I had printed out over the years, over the previous 20, 25 years of trading of my trades. And when we were moving, I had to throw all this stuff away. Well, I'm sort of a pack rat. I don't like to throw things away. You know, it's just the way I am. My wife is a neat freak, so you know we're the typical odd couple. But so I would sit down. I would put those use these large double sheet trash bags to throw these things away. But I'd pick up a stack and I'd start looking at them. And so 3 hours later, I'd be sitting on the floor with a stack of charts that I had annotated, 10 or 15 years ago. It was fascinating. And I learned a lot from it. And that's really how I taught myself to trade, more specifically, how I proved to myself that I could trade. Because I could see my mistakes over and over and over and over. Eventually, it hits you in the face and you go, okay, you've done that 12 times now. Do you really need to do it a 13th? And you finally learn. But it took me days to get rid of all those charts, not only because I had so many of them, but because I kept going through them. But it's the most valuable thing in trading that I've ever done. And I can't overemphasize how important and how valuable it can be if you will do the same thing. Question everything. That's the basis of critical thinking. Ask questions. Why? Why does this work? Why did you say that? Why is this level important? Why does the market do this? Why is the market moving up and down? Why is the market trending now? Is there a reason for that? Is the market just random? Now, here's some just general observations about traders. Traders trade way too much, especially day traders. There are probably, maybe on a good day, in a given contract, 3 good trades, intraday trades, 3 good trades, maybe on a good day. And some days in a given contract, there's not a good trade. So that's a reason that's one thing that's a big mistake traders make, is that they obsess over trading, let's just say the S&P Mini, which happens to be the most difficult contract to trade in any time frame. The stock index futures are the most difficult contracts to trade, but everybody flocks to them because that's what's promoted, again, by our friends in the industry. Risk is grossly misunderstood. Most people think, well, gee, I'm going to trade on a tick chart because there's less risk. Well, no. What you're doing, you're jumping into the middle of the fire. You don't decrease risk by trading smaller time frames. You're actually increasing your risk because, and again, the purpose of the market, and I'm going to go through this in a minute, is to facilitate trade. Most price activity is noise. That's how the market's designed. So the smaller you go down in time frame, the more you're attempting to make a consistent profit in a random environment. That's extremely difficult, if not impossible to do. Maybe you're that rare savant that can pull it off, but I've never met the savant that could pull it off and keep their money doing that. So scalping is an implicit admission that you don't understand how the market works. And it's a legacy, again, of the floor traders who were market makers, really not traders. You have to pay the bid-ask spread. They did not. And there was a constant flow of orders in and out of the pit. Now I'm going to show you something for your consideration, and this is just a gross 10,000 foot level view of something that you might want to consider. You have to have a valid understanding of how markets work. That's what I start with as a trader. It's what I start with as a trading educator, is teaching people how the market works based on a very, very specific set of precepts. And that is based on how an auction works. We are trading auction markets. That is an irrefutable fact. We are trading auction markets. If you understand that there is an organized auction process, it helps explain how markets are behaving, why they behave the way they behave. It's basically telling you, once you understand this auction process, it's giving you the information that you're trying to get from the 7,000 indicators you have on your screen. Now, Peter Stettlemyer, you may or may not know, if you're familiar with Market Profile, you surely heard the name of Peter Stettlemyer. Peter Stettlemyer is sort of the father of Market Profile. And Market Profile, like everything in trader land, has been hijacked by the magicians, and there's this attempt to turn it into magic, to turn it into some sort of magical trading platform that all you need to do is take all these rote trades. You have all the value area high and the point of control and naked point of control and all this nonsense that's sprung up around Market Profile. It doesn't work. It was proven shortly after Stettlemyer posited the concept that those rote trades that everybody read in Mind Over Markets don't work. And I know the guy that disproved this, guy named Don Jones. Don's a friend of mine. But I digress a little bit. This is an explicit trading book if you want to get a good trading book. And I think it's Stettlemyer's best book. It's 141 West Jackson. And not so much about, well, it is about Market Profile, but it's about trading in general. It is outstanding. But Peter Stettlemyer's quote in 1996 was, now this was, we're talking about 22 years ago, the evolution of the fundamentals of Market Profile has been lost on the majority of users because most of the interest was in using it to make trading decisions rather than in understanding the market. You know, Stettlemyer's initial attempt was to present a graphing format that the off-floor trader, you know, Stettlemyer posited this concept back in the 1980s when the floor still basically ruled, and we didn't have the same access to information that the floor did. And so he came up with a profile graph that is a absolutely brilliant graphical view of an auction process, the auction process that was in effect on the floor, and the auction process actually, and this was later best explained by Don Jones, is actually in effect in all degrees of time all the time, and it's the larger degrees of the auction that we really need to be paying attention to if we're going to make money in the smaller degrees of the auction. But Stettlemyer in 1996 was telling people, hey guys, Market Profile as you're using it doesn't work. Stettlemyer had moved on from that initial concept 22 years ago, but I still see all this nonsensical stuff that's legacy Market Profile concepts. You don't want to be a Market Profile trader. You want to be an auction market trader. You want to understand how the market works. Market Profile was developed and designed as a tool to understand the market, not as a trading system. The purpose of a market is to facilitate trade. Our markets, the markets we trade, are auction markets. Trade facilitation through an auction market mechanism, organically creates a system that determines value via the actions of the buyers and sellers. It is an elegantly simple, elegantly consistent, and it's the most objective means, in my mind, of determining true market value of anything out there. It is more fundamental than anything your typical fundamental analyst could ever dream of. I put technical analysts and financial analysis in the same boat. They both constantly resort to pretzel logic to justify their existence and their view of the market. Well, the market, if you learned how to view the market, the market is comprised of buyers and sellers. And that's all you need to know. You need to understand what they are doing and why. And you can see it on a chart. You can see how much they're doing it, where they're doing it, and actually, if you understand the market, why they're doing what they're doing. So this very consistent auction market process follows steps. It's a development of process that occurs in all markets, all time frames, and I'm gonna dare use a word that I don't like to use because it is one of the most overused words in trading, and trillions of dollars have been spent chasing something that can predict markets. But guys, gals, I'm going to tell you, there is nothing that at times that can predict a market more accurately than can this view of the auction process and understanding that market process. There are times when it's uncanny how much you can consistently and accurately predict about market behavior when you understand this auction process. Now, trade activity, because the purpose of the market is to facilitate trade, it just makes sense that it's predominantly random, but it's also predominantly orderly. So ideally, we only want to be trading where and when there's the greatest probability of a non-random price movement, a trend. And that's what this methodology can help us do. Remember, the purpose of a market is to facilitate trade, and the above basically describes that. Most price activity is random because it's driven by the process of trade facilitation. Most of the time, as traders, I don't care what time frame you trade, if you call yourself a day trader, a swing trader, or a position trader, most of the time we shouldn't be trading, people. We are all floor traders. It's a huge edge that the vast majority of all floor traders give up. They give it back. They sit there and think, well, I'm a trader and I have to justify my existence by trading 60 times today. Well, if you're doing that, you're going to go insane, number one, and I'm not sure what happens first. If you're going to go crazy, you're going to lose all your money. Your job as a trader is not to click the mouse. Not trading is trading. Your job is to identify trade opportunity that gives you a positive expectancy. So most of the time we shouldn't be trading. Now, one of the reasons traders have such a difficult time with this is because they don't have a basis for understanding that. So they're nervous if they're out of the market, and they're nervous if they're in the market. If they're out of the market, they think they're missing something, and if they're in the market, they're afraid they're going to have yet another losing trade. So it's sort of a vicious cycle. Why do we do this to ourselves, people? Here's another something absolute. There are very few absolutes in life, but this is one. Developing a trade plan that has a positive expectancy isn't simply a good idea. It's an absolute must. You have to have a positive expectancy. You have to have at least an elemental understanding of what expectancy is. And to keep it simple, expectancy can be derived through in trading one of two ways. You can have a very high percentage of winning trades, or you can have fewer winning trades, but much larger winning than losing trades. As a matter of fact, you can actually have 55, 60% winning trades and lose money. And that's very easy to do. especially if you are one of these super twitch traders that trades on tick charts. On the other hand, you can have 35 or 40% winning trades and just knock it out of the park consistently. And it gives you a much larger margin for error in your trading if you're consistently looking for that trade that gives you, if X is your risk, gives you 3, 4, 5, 6, 7, 8, 9, 10x potential return. And I'm talking about all time frames. You can have intraday trades that give you 10 times your initial risk. I'm going to show you real briefly here. Now, these are profile charts. This is the S&P Mini. I just want to show you the auction, okay? So this is the S&P Mini. This is the October auction. You can see the October, November, and then the December auction through 12/7. Now, if you understand auction market concepts, there is a wealth of information on this chart. It's really giving you wonderful context. Now, I use market profile charts and I use bar charts. When I am trading, this is my context. But on my trading screen, I'll show you my trading screen in a minute. I have a daily bar chart, I have a 30-minute bar chart, and I have a 5-minute bar chart. Because I always, if I'm trading on a 5-minute time frame, if I'm trading intraday, I want to know the bigger context. I want to know this information that's on the screen, and then I can fine tune it and I can confirm what's going on the bar chart. Now, this is the the October through December auction. You know, one of the pitfalls of market profile is because it's a computerized binary program. There has to be definition to it. Markets, the auction market is a flow. There's no, there's a constant flow, and I have this divided into the monthly auctions, but really what you see here, this is the effective auction. This is really stock index futures traders. This is what we're trading right now. And actually, I printed this slide a few days ago, but it's pretty close to accurate now. This is the auction we're trading. This is the context that I need to know as a trader about making trade decisions, regardless of the time frame that I trade. Now, all auctions will develop these 3 primary key reference areas. Now, I'm showing you guys, let's call it intermediate term, daily intermediate term charts here, but the exact same concepts apply on a 5-minute bar chart as they do on this chart. The exact same concepts. The auction process is in effect in all degrees of time, all the time, in all contracts. That's what makes it such an extraordinarily robust methodology. So all auctions will develop these 3 primary key reference areas. This is very, very important. You have an upper extreme, a lower extreme, and the high volume node. The high volume node is the place where the most activity is occurring. Now, from these 3 areas, if you take a trade anywhere in this circle, you have an inherent positive expectancy. If you were to only trade when the market is in one of these 3 areas, but when the market got to that area, you said, okay, I don't know which way it's going. I'm going to flip a coin. I'm going to go heads or tails. Heads long, tails short. Over a large sample of trades, you would have a positive expectancy because the market is going to move sharply away when it reaches the upper extreme, the high volume node, or the lower extreme. It's not if, it's when, and it will. So that itself helps us with making any number of trade decisions. Where to trade, when to trade, and then you can fine tune it. There's more variability in how to trade, obviously. So in conclusion, this is another quote from the Liz Verret article that I shared with you. This is the meat part of that quote. This should serve as a reminder that we should always remain open to the possibility of changing our minds if strong enough evidence emerges. And most importantly, we must remember to see our deepest beliefs for what they ultimately are, just another prior probability floating in a sea of uncertainty. You have to be willing to accept a certain amount of uncertainty in trading, or you will not be able to trade. Markets are primarily random. Markets are primarily, price movement is primarily noise. So you want to be able to develop a trade plan that enables you to identify where and when to trade, where you have the greatest probability of non-random price movement. And that's everything that I do as a trader, and everything I teach as a trading educator is built around that concept. So if you're willing to sit back and take a look and question what you're doing, you'll go along, regardless of whether or not you think the methodology that I use works or not. If you will, your takeaway from this, if I could have you take something away, is that you are willing to think about what you're doing, why you're doing it, how you're doing it, and if it's not working, be willing to admit that and be willing to change it. Now, I don't have anything to sell you. I want to give you something. I publish a nightly newsletter. It's based on auction market concepts, market profile. I do put actionable ideas in there, and I also put things that can stick with you. I try to educate when I'm writing this newsletter every night, and it's free. If you go to my website, drop down comes up. You put your email address and your name in there, and you'll get on a list, and you'll start receiving it. Or you can email me at tom@alexandertrading.com, and I'll be happy to share the newsletter with you. At this point, I'm happy to take any questions that you may have. Have I stupefied all of you?
Yeah, I think so. I don't see any questions.
Well, Ron, let me take the opportunity to thank you for having me. This has been fun. I've enjoyed it.
You bet. No, there are questions coming in, Tom. Do you wanna? Can you see those?
Yeah. Can I? From the recession. What recession? Which one?
It says, can you share a market profile graph from the recession?
Yeah, that's. Hold on a minute. Yeah, the answer is yes, but you're gonna have to tell me what recession. You're talking about 2008, 2009?
Yeah, he's got 2008.
Okay, sure. Be happy to do that. Let's do this. And by the way, you bring up a really good question. If I were to show you, and I've got it somewhere, I don't have it prepared, I can show you a graph of the Dow Jones Industrial Average from the 1920s. And if I take the scale off and the labels off, you can't tell if it's the 1925, 1930, or 2018. All right, let me find 2016. Let's go back in here. All right, here you go. Now, everybody, this brings up a really interesting point. I don't want to get too far off topic, but you look at these shapes. You have this Gaussian-looking shape that's ubiquitous on a market profile chart. The reason it's ubiquitous is because it's displaying the auction. It's displaying the drive of the market towards efficiency, towards trade facilitation. There were 8 days in October of 2008 where the market dropped like 30%. It was down day after day after day. If you look on a bar chart, you see it opened at the top and it closed at the bottom day after day after day. But if you go inside those days with a profile chart, this is what you see. You see a very orderly decline. And that's what I meant before by price can appear random, but it is orderly. And it's orderly in all time frames. So you can have what most people consider to be the worst part of the crash into the 2009 low. But if you break those days down and you go inside and you look at each day's auction, it's a very orderly process, and it looks not unlike what we're seeing here. This happens to be a quarterly time frame. Each one of these auctions is quarterly, but You know, it never ceases to amaze me the elegance of this auction process, and that's what this particular graphing format displays. It's displaying the elegance and the consistency of that auction process. All right, let's see. Other questions. Hold on, let me expand this a little bit here, Ron. Do you volume profile also? No is the short answer. And the reason I can, I mean, my charting platform offers it. I find that it's not nearly as accurate or as usable from a trading perspective as is your traditional TPO-based profile. And you know, volume is the magic du jour. Everybody wants to parse out volume 17 different ways. And that I could give an hour webinar on that alone. But volume is not as it is presented to you guys. Would I post my 30-minute and 5-minute bar chart? Yeah, I'll show you. I told you I'd do that. I forgot about that. Okay, here, let me find, let me find various contracts today. These are my trading screens, guys. This is what I trade. You don't see a lot of crap on my screens. I am crap adverse. You know, this is stuff that I annotated in my trade room today for the traders in my room, just pointing stuff out. This happens to be soybeans. Now, let me show you a couple of things here, okay? This is what you sort of train yourself to do. I told you before, when I'm trading, I'm looking at bar charts. But when I look at bar charts, this is a balance area. This is that Gaussian shape right here on the daily chart. And then on the 30-minute chart, here's that Gaussian shape also. And then on a 5-minute chart, you've got, you know, numerous levels in here. This was a trade idea in beans today. And I put this up there before it occurred. But guys, you know, there is nothing more robust for trading any contract than this methodology. Now, you're looking at beans here. The only reason I have beans on my screen is because it was in a market condition that I thought would be conducive to trading today, regardless of the time frame, whether you're a swing trader, a day trader, whatever. You know, everybody wants to stare at the stock index futures all day, which are typically almost every day a complete chop fest. But for my money, if you're a day trader, you're better off trading the currencies, gold, crude, occasionally, and then I'll cherry pick markets. You know, if wheat or corn or beans or some of the softs, cotton, cocoa, sugar get in a certain market condition, then they can be great traders too. But that's what this methodology allows you to do. It allows you to trade opportunistically. You're truly trading for opportunity. You're not obsessed with saying, oh, well, I'm an S&P trader, or even worse, oh, well, I'm an S&P mini day trader. Well, that's not smart. You're limiting yourself, and you're making it hard on yourself when you do that. Let's see, what else? Yeah, you guys are asking me a lot of very specific questions that we really don't have time to get into it. I don't mean to put you off, but I promise you, if you will sign up for this newsletter and go to my website, I have a ton of free resources that will answer a lot of these questions you're asking me. I use eSignal. Somebody asked that. That's an easy one. Do you prefer to trade the S&P, Dow, NASDAQ, Russell of the four majors? Of the four of those, I'd rather trade the Russell. Most future traders do so only in the morning. Do you recommend against futures trading in the afternoon sessions? Not necessarily. I think the markets tend to be more active up until noon. All right, somebody says, do you think it's best to trade in the high volume node or wait for it to start forming a top tail? Well, I'm not sure what you mean by top tail, but the high volume node is one of the three extremes. It's one of the areas from where you have a positive expectancy. When a market is trading at its high volume node in a multi-day auction, you can know with certainty it's going to trade to the top and take it out, or it's going to trade to the bottom and take it out, but it's going to at least trade to one extreme or the other. And again, you guys can email me, tom@alexandertrading.com. I'm happy to answer your questions if you have questions. And I have a ton of, if you sign up for my newsletter, you'll get a ton of free information and resources. how did I learn to use Market Profile? I learned to use I started using Market Profile shortly after Peter Stettlemyre posited the concept in the mid-1980s. And I have studied Stettlemyre's work. I have spent time with Stettlemyre. I've spent an enormous amount of time with a man named Don Jones, who is an extraordinary individual and trader. And then I've studied myself. I'm a trader. A lot of what I've learned is through my own experience, but I try to honor my who I would consider to be my mentors, Stettlemyre, Don Jones, and be intellectually honest about what I'm doing and apply rigor to it. Yeah, Richard, you asked a question. Do you use volume strips or Stettlemyre's laser lines? I know years ago, like 10 years or so ago, I subscribed to Stettlemyre's CapFlow software. And at that point, in my opinion, Stettlemyre had sort of jumped the shark with what he was doing. And initially, Stettlemyre, and I always admired him for being so public and sharing this Market Profile concept with people, and he basically gave it to the CBOT. And then he decided to go secret squirrel and develop this software program. And I do understand now, because I've studied it so much, what he was doing, but it's not really disclosed. And again, I am a huge fan of and admirer of Peter Stettlemyre, but one of his strengths is not communication. And he has a rather abstruse way of explaining things that many people find difficult. And the laser line stuff and the stuff in his software, I don't think is necessary. I think the same thing can be accomplished and explained in much simpler fashion. Dalton's stuff is a regurgitation of initial Market Profile concepts posited by Stettlemyre when it first came out.
Well, that looks like that's it, Tom. Great lesson today. I appreciate it.
Well, I appreciate it. Thank you, Ron. It's been fun.
Yeah. Let me make a quick announcement of our next guest, and I have a question to ask you. Today's webinar with Tom Alexander was the last one scheduled for this year. In January, Dan Sheridan will give a presentation on the topic, a plan for trading in your retirement account. And that would be focusing on options, of course. In the webinar, he will cover the proper allocation of capital, best strategies to use, worst strategies to use, proper position sizing, simple risk management techniques, and portfolio protection. The webinar announcement will be out in a day or so. We now have 125 video recordings and nearly 250 audio recordings of presentations, both seminars and webinars, by traders and educators that are a great resource of information for any trader. All are available for a small annual subscription, so go to denvertradinggroup.com and sign up. Do it today. Tom, we were talking yesterday about our mutual friend, 80 plus years old friend and scientist, Don Jones.
Yes, I tried to call Don.
Yeah, I hope he's doing well, but he has contributed so much to Market Profile, as we discussed. As a beneficiary of his website content, have you thought about making some of his courses? And years and years ago, I bought the short course. And other information available on his site, on your website?
That is on my list of things to do.
Okay, good.
But I tried to call Don. I tried to call him yesterday, as a matter of fact, after our conversation, and the number that I had is not working, so I have some concern there. But yeah, at some point I'll do that. But I think I've told you this before, and I've publicly said this many, many times, almost in every presentation I do. What I learned from Don is invaluable to me. The most important things about trading, I think I learned from Don, and he did more really to validate the concepts that Stettlemyer initially posited than anybody in the business. And he also pointed out the importance of context, of the larger degree auction that is in effect. And that's something that Stettlemyer did not do. Stettlemyer initially used market profile in a very discrete manner as a day-to-day auction, and not really going too much further back than the previous day, and using it as a predictive tool. And Don Jones basically carried it further and showed what was valid about that concept, and then also exposed what was invalid. So his work, and you and I had this conversation, is never going to be appreciated because he just was not the Carnival Barker type. So, and he was a scientist. You know, he was very dry, very matter of fact. Things were presented in a very binary, open way that you know, it was part of his personality. But it was great.
Yeah. Well, Tom, thanks again for coming back and giving the presentation today. We appreciate your long support of the DTG, your honesty and contributions you've made to the trading community. We also want to thank everyone for attending today. Enjoy the rest of your day and take care, everyone.
Good night.
Good night, Tom. And I wish all of you a very Merry Christmas and a healthy, happy, and prosperous 2019.